We are conditioned to put all our weight on a single pillar. The modern financial machine demands we push every available dollar into the market to maximize our returns. We are repeatedly told that holding cash is a guaranteed loss. To outpace inflation, we sprint toward the highest risk profile available, placing our entire net worth into a single asset class. This creates a portfolio that feels like walking a tightrope. When the economic weather changes or the market shifts, the resulting anxiety is immediate. The vehicles we use to build wealth have evolved over the last century, but the human reaction to losing it remains identical. We panic. Pushing all your capital into a single asset class does not guarantee a higher return. It guarantees maximum vulnerability when the cycle inevitably ends. Over 1,500 years ago, a distinct wealth-building principle was recorded in the Talmud. Often attributed to King Solomon, it was designed to withstand the unpredictable forces of the world. The rule requires a strict division of capital. A portfolio is separated into 3 equal parts. 1/3 is allocated to land, 1/3 to business, and 1/3 is held in cash reserves. Modern finance obsesses over the ceiling, how high a portfolio can climb and how fast it can get there. This mathematical structure obsesses over the floor. It asks how hard an investor can fall without breaking. Like a tripod, a portfolio built on 3 equal pillars is geometrically stable. A total collapse in one sector leaves the other 2 standing to carry the weight. The first third of this structure is the growth engine, business. This is the source of compounding returns. Centuries ago, this meant financing spice trades across the ocean. Today, it means taking an ownership stake in productive assets that generate revenue while you sleep. This leg carries tremendous risk. New technologies wipe out established industries, consumer habits shift, and individual businesses frequently fail. For a modern beginner, this risk is managed by purchasing broad, low-cost index funds or ETFs. You acquire a fractional piece of the entire global economy. Business ownership provides the highest potential upside for wealth creation, but because of its extreme volatility, it requires the other 2 legs to keep the structure upright. The second third is land. It is a finite, physical reality in an increasingly digital world. Real estate naturally defends wealth against inflation. As the purchasing power of currency declines, the value of physical property and the cash flow it generates from rent typically rise to match it. If purchasing a direct rental property is currently out of reach, this allocation can start by saving for a primary residence or investing in real estate investment trusts. The heavy, boring nature of physical property is its primary function. It acts as an anchor, insulating your portfolio from the manic daily swings of the stock market. The final third is cash reserves. For a modern investor, this is often the most psychologically difficult asset to hold. We are trained to view cash as a wasted opportunity. Watching an account yield minimal interest while the stock market climbs creates immense pressure to invest it. But a market correction is a mathematical certainty. For the speculator with 100% of their money tied up in risk assets, a crash induces immediate paralysis as their net worth melts down. The investor following the 33. This structure requires a mechanical discipline, rebalancing. If stock investments experience a massive bull run, swelling to 50% of your portfolio, you systematically trim surplus profits, funneling excess capital into land or cash positions to restore equilibrium. This automated mechanic removes emotion from the equation. It forces an investor to systematically sell high and buy low, preventing them from over-leveraging at the absolute top of a market bubble. A traditional speculator measures success by tracking daily ticker symbols and housing prices. A balanced investor ignores the noise and measures success by the health of their entire financial ecosystem. You do not need to reach perfectly equal thirds on day one. The path forward is sequential. You begin by accumulating the cash reserve. That liquidity allows you to confidently step into the business leg through index funds, which eventually generates the capital needed to step into real estate. The objective is a deliberate movement toward this ratio over a timeline of decades, building a foundation solid enough to pass down to the next generation. Financial freedom is ultimately a state of being. The 33% rule removes desperation. It turns investing from an anxious gamble into an indestructible fortress.